Friends, it's a very heartwarming detail that my team has brought to my notice that this is our 200th edition of the weekly market outlook in the video format. Prior to this video format, for many years, I used to send you our weekend newsletter in a PDF format, and that is so nostalgic. We used to call it Mott's Musing. And what a way this journey has progressed. From approximately 600 to 800 followers, we are now up to 17,000 plus followers and counting. Do keep your support coming to us, your warmth, your feedback, your positive and constructive help and guidance has been our guiding light. Thank you very much. Hello friends. Last week in my video, I basically discussed whether bears would be forced to cover their short positions by the bulls who would push them into a short squeeze. And look what happened. You actually saw a short squeeze in the market, lifting the indices higher. The Bank Nifty rose on 3 out of 5 trading sessions. The Nifty went up on 4 out of 5 trading sessions. And both of these indices touched new all-time highs. Now in this video, I'm going to discuss whether this propulsion, whether this rally is likely to sustain, and if it is likely to sustain, what is needed to make it sustain in the first place. Now friends, before I proceed further with this video, a reminder that you can watch all my videos with the subtitles in any language of your choice, and I hope you remember, here is how you can do it. You basically click on the second button from the left on the bottom of your YouTube window, and that's a geared wheel. You click on that, a pop-up window opens, and you know the rest. Now friends, before we proceed further in this video, a few points that we need to discuss. First of all, the short covering was ahead of expiry. It was expected and it happened. Secondly, this is the month of September. It's the second quarter of the financial year which has ended, and it is rather ending on 30th of September, which is Monday. So normally mutual funds, in order to declare good quarterly NAVs, do tend to push the markets higher, and we'll know after Monday as to whether this propulsion will continue from the mutual fund side. Thirdly, this is a shorter week ahead. 2nd of October is Mahatma Gandhi Jayanti, and therefore this week is a 4 trading session week. Normally, history has shown us that there tends to be a slight tilt towards the bulls whenever the weeks are shorter, because it's easier to lift the markets on fewer days. Fourthly, the Indian foreign exchange reserves have jumped to an all-time high of $692.296 billion. That's made the rupee stronger, and which is a good thing. Oil has fallen sharply last week, and I have been telling you I don't believe in the supercycle theory or the hypothesis which many people have been loosely throwing around of 100, 120, even $200 a barrel. So falling oil prices eases the threat of inflation, and then you have the magic of the US elections ahead, because of which the economic data will be basically massaged, and interest rates are of course falling. And do remember the final point. A short squeeze can push markets higher. It can cause a temporary rally, but it takes follow-up buying to continue to push the markets higher and maintain the trajectory upwards. So follow-up buying is very, very important. So in the 4 days ahead, trading days ahead of you, please monitor the advanced decline ratio, monitor the traded volumes, the ticket size per trade, MWPL, and the churn ratio. You know how to do it. I've discussed it in this video. Friends, I now come to our usual metrics, and on your screen right now is the weekly market roundup window. It was the broader based Nifty 50 as usual, leading the markets higher. The Bank Nifty just about managed to gain a little bit here and there. And the US dollar index continued to fall again. It's now precariously poised at the triple digit mark. It's just a whiskers difference or distance away from falling into double digits. And that is very positive for emerging markets, number one. Number two, it boosts commodity prices. Typically speaking, bullion tends to rise when the dollar eases. Remember, the dollar is the invoicing currency in the international commodity market. So it's like a seesaw. When you put a heavier kid, that side of the seesaw goes down and it lifts the lighter kid up. So commodity prices went up, including metals, bullion, energy, etc. Energy, typically natural gas because of Hurricane Helene. We'll discuss that later. The USD INR basically saw a jump. It's nothing but the cost of carry. The 24 paise jump that you're seeing in the USD INR is because the September series has expired and the October series has started. Do not make the mistake of thinking that it's a normal kind of a breakout. NSE gained 1.32% in market capitalization, and the Indian 10-year benchmark bond yield was unchanged at 6.76. The MWPL fell routinely. Don't forget the last week was an expiry week. The US headline indices basically gained, and that provided tailwinds to our markets. Friends, I now come to the ratio chart between the Bank Nifty and the Nifty 50. Unfortunately, the Bank Nifty could not hold the enthusiasm that it showed in the last couple of weeks. And here you see the weekly chart showing you that the Bank Nifty has fallen yet again. So it was a temporary 2-week blip up on the screen, and I told you that I would ideally want the Bank Nifty versus the Nifty 50 ratio to go up above 2.3 if not 2.4 before I can say that the rally is sustainable. Now friends, why am I showing you the ratio chart? Look at the weightages that you're seeing in this screen up here. Very simply put, the banking and financial sector is commanding a weightage which is equal to the weightage commanded by the following three sectors put together. Unless you have a rally in banking and financial sector stocks, forget about a sustainable bull market in the Indian financial markets. So which is why you must, whether you like it or not, if you're a Nifty trader, you must watch the Bank Nifty because both are joined at the hip just like Siamese twins are. Now friends, I come to our in-house indicators and I start with market-wide position limits. I do hope you've seen this video in which I have explained to you how to make sense and sensibility of market-wide position limits, how it is important for you, how it will improve your trading profits, and what other studies that you can join and combine with the MWPL to raise your probabilities of success even higher. I would love to have your feedback on that, please. So let's return to the market-wide position limits. It's fallen routinely, and do remember this is because of expiry, but at 31.37 it has fallen below the low made post expiry last month at 31.92. It's not a coincidence that the peak made in the September derivative series at 43.28 is also lower than the peak made in August at 44.79. Basically what it tells us is that traders are showing a little bit, just a little bit, very mild caution at higher levels. Let's not forget it's an all-time high. So they are not really holding on to large size positions. Now this is something that you need to monitor in real time. And I provide these figures daily on my social media accounts. So do connect with me there. My contact coordinates are there in the pinned comment below and at the fag end of this video as well. Now friends, I come to the stock and index turnover. Basically, these are three concurrent series. So it is October, November and December. Do note how every 4 weeks the turnover comes down. That is the turnover falling post expiry. In the expiring week, the turnover goes up because traders tend to square up their positions in the expiring month and initiate the same in the next month, which is why there's a dual turnover. But the fact remains that they are rolling over their positions also is a sign of higher risk appetite. So I would say that risk appetite and participation remained at robust and healthy levels. Now, friends, I come to the advanced decline ratio. Now, the red color line is the Nifty's gain and loss. The Nifty for the second week in a row made gains but smaller compared to the previous week. And the advanced decline ratio, this is the average of all 5 trading sessions put together last week. The average advanced decline ratio still remained at 0.98. Although it's better than the prior week, but for every 100 losers, there were only 98 gainers. I'm not saying that I'm feeling all warm inside my heart. I need a higher advanced decline ratio. That would tell me that intraday traders or one Marshmallow traders are showing increased risk appetite. The Marshmallow theory of trading is explained in a video. All the videos that I want you to see are in the pinned comment below and in the description below this video. Friends, I now come to the basis. Now, what is basis? Basis is nothing but the premium or discount prevalent in the future compared to spot. Like the options premium, basis also tends to contract as we head towards expiry. But look at what's happened. And this will explain to you why I've been warning you that statistical beta will rise. Before expiring in the September series, your Bank Nifty basis was a negative of 242 rupees. And now that we've seen the expiry of September and traders have got the new October series open to them, naturally, since they have full 4 weeks to play ahead, they are willing to pay a premium. But look at the difference. From minus 242, you're now plus 386. And this 386 premium is the highest in many months. That means there was short covering. This kind of premium is not something that indicates only risk appetite. It is primarily because the bears have been taken to the cleaners. They've been beaten black and blue and they've covered their short positions at very hefty premiums. Will this premium last? I would say it will not last. But as long as the futures are trading at a premium, that's all right. Even the Nifty premium at 166 is a multi-month high. Here again, I would bet that the premium will come down over a period of time, just like options premium erodes towards expiry. Now let's see the impetus. Impetus is our in-house indicator. You've enjoyed it for 4 years now. The Nifty impetus was higher. That means the rally in the Nifty was on greater momentum, greater force. But look at what's happened in the Bank Nifty. It's just about managed to clock very small gains. Let's not forget the Bank Nifty did not really gain anything. It actually fell. On Friday, it logged big falls and therefore the force was missing in the Bank Nifty. A word of caution here. You do remember I have talked to you about how the two indices, the Nifty and the Bank Nifty, are like two wheels in a bicycle. Take a look at what's in the graphic above. You can't have one wheel broken or one wheel going clockwise, the other going counterclockwise. That's the surest signal of the bicycle toppling. Now, if the Bank Nifty and the Nifty do not move in tandem, and the banking and financial sector stocks command a 32.6% weightage in the Nifty itself, please convince me, because I believe in statistics and mathematics, please convince me mathematically how I should feel confident about this rally being robust. Yes, it will continue on short covering. I'm not saying it won't. But how is it robust? It's not a robust rally. It's because bears are covering their shorts. What happens after they have finished covering their shorts? That is what I'm getting at. Friends, let's now go to our lift weight thrust drag indicator. You've trusted it for almost 3.5 years now. And what you're seeing here again, just like the basis, the lift weight thrust drag indicator was minus 0.14 last week and it has jumped to plus 0.29. Now, this tells you that the extreme thrashing about that there was in the market from negative to positive, that obviously means a lot of volatility and statistical beta readings. Now, here is why you must basically maintain hacienda hedges or tail risk hedges. I've explained the tail risk hedge concept in a separate video. Please make it a point to watch that video. Friends, the indicators done, I now come to the bond markets, and this is a market that is very close to my heart. The bond yields have more or less stabilized at 6.76. It is something that I told you a couple of weeks ago. Between 6.75 and 6.80, I see the bond yields stabilizing in the near term. And there you have it. Now, what we will need to watch is what happens next. If at all the Dixie falls to triple digits, which it might because the US is now contemplating another rate cut in November, failing which may be December, and the miracle of falling inflation in the US, I'm calling it a miracle in inverted commas because I told you I don't believe in coincidences. And I've also warned you at the beginning of this year how elections in more than 60 countries will mean that economic data will be massaged and feel-good factor will be spread. So this, am I saying the feel-good factor is being spread in the US? Yes, I'm sticking my neck out and saying that. So this falling inflation is likely to basically see the grounds being prepared for another rate cut in the US. And if that happens, maybe, just maybe, our very own RBI might just give out an announcement that they either will cut rates or they will contemplate cutting rates at a later stage. So there you will see the bond yield start to make their next move. We'll take a call when we reach that bridge. Friends, the bond market's done. I now come to the bank Nifty. And as you can see on the daily chart on your screen, the bank Nifty has basically risen on 3 out of 5 trading sessions. It clocked minuscule gains of 0.08%. But Friday's fall was what you would call whack-a-mole. Now, Friday's fall was slam dunk and a whack-a-mole, and it erased all the gains that the week had clocked earlier. Now, the Friday fall was on a bearish power candle. Do remember this video here. I have shared with you my views that were basically promulgated by Richard Donchian, an extremely popular and extremely brilliant technical analyst in the 1960s and 1970s in America. Donchian said that the closing of Friday is extremely critical for all traders to watch out for. The details are in that video. Do make it a point to watch that, please. For real world traders, this power candle, a bearish power candle, is a cause for concern. The price, however, remains above its month-long moving average, which itself is rising. So the short-term outlook is positive for now. The Bank Nifty made a new all-time high before it retreated on Friday. So there is interest in the index, but follow-up buying is extremely crucial. Don't forget that this weightage of this sector is 32.60%. So without a rally in banking, there cannot be a rally in the Nifty. Take a look at the weekly chart on your screen, and now what you're seeing is a very strange phenomena. The weekly candle is an inverted hammer, which means the bulls attempted to drive the prices higher, proved to be ineffective, and surrendered ground, where the opening and the closing are almost the same, and the intra-week high was something that was never scaled again. This is a bearish indicator, although I'm not saying it's a reversal, a confirmed reversal. Follow-up action will determine whether it is a reversal or not. But this bearishness can be overcome if follow-up buying emerges. So at this point in time, the price is above its 25-week exponential moving average, which happens to be a proxy for a 6-month long holding on cost, and also above its bullish wedge upper trend line. So the medium-term outlook is positive for now. I would suggest we keep watching this index keenly for trend determination of the overall markets. Friends, in the week before last, this index was number 4 on the most volatile counters list as per statistical beta rankings that I maintain in-house. It rose 1 notch to number 3, and that tells me that the challenge level for retail traders just went up. Last week, I estimated a range between 55,275 on the upside and 52,300 on the downside, which held perfectly well. In the coming week, I estimate a range between 55,400 on the upside and 52,250 on the downside. Friends, in addition to these levels, please do monitor the daily, weekly, and monthly pivots that we put up on our Telegram and WhatsApp channels. The hyperlinks to these are in the description and the pinned comment below this video. Friends, the Bank Nifty done, I now come to the Nifty 50, and as you can see on the daily chart on your screen, this index has risen on 4 out of 5 trading sessions last week, in the bargain clocking 1.50% gains. Friday's fall, unlike the Bank Nifty, Friday's fall on the Nifty was very tiny. So this index is, relatively speaking, as the chart will tell you, stronger compared to the Bank Nifty. The price is above its month-long moving average, so the short-term outlook is positive for now. But the difference between the price and the moving average is fairly wide, so there can be some consolidation so that the price either goes sideways while the moving average comes and catches up, or the price might even fall a bit. Moving to the weekly chart, what we see is that the weekly candle that it has logged is even smaller compared to the bullish candle of the prior week. And the prior week's candle in turn was smaller than the previous week, preceding week before it. So what we are basically surmising from this is that the ranges of the Nifty are contracting at higher levels, which means the momentum mildly hesitant. We need more aggressive buying. Let's not forget one of the two indices was weak. So I'm willing to give it a benefit of the doubt. Now the price is above its 25-week exponential moving average, which is a proxy for the 6-month-long holding on cost of an average bull. So the medium-term outlook is positive for now. Here again, the difference between the price and the index is huge. That indicates the possibility of consolidation or a correction. In the week before last, this index was at number 10 on our most volatile counters list. That is where it remained. So the challenge level was unchanged. Now, last week, I estimated a range between 26,375 on the upside and 25,225 on the downside, which held perfectly well. In the coming week, I estimate a range between 26,775 on the upside and 25,600 on the downside. Here again, in addition to these levels, please watch our daily, weekly, and monthly pivots that we put up on our free Telegram and WhatsApp channels. Friends, I now come to the last bit of statistical analysis, wherein I gauge the risk appetite of the retail space by way of their turnover contributed in the 4 segments in the derivative space. Now take a look at the weekly chart on your screen. What it tells you is that the index futures turnover was up by 2 basis points. It is indicated as a blue line. The stock futures turnover was a healthy 40 basis points higher, indicated as a red line. The index options turnover fell by 24 basis points, indicated as a green line, and stock options turnover fell by 18 basis points, indicated as a purple line. Now friends, why did this happen? It's partly because of expiry. Do remember what I told you, traders square up their trades in the expiring month and roll them over to the next month. That results in double turnover. Typically happens in futures, less in options, which is why the futures turnover has risen more than the options turnover. Risk appetite, you could say, is partly because of turnover due to rollover. But isn't rollover also a measure of risk appetite? If it is only because I want to take risks that I will roll over my trade. So I would say yes, risk appetite still remains healthy. Now friends, I'll come to my weekly trading strategy. What I frankly saw on Friday was a little bit of red on interest rate sensitives, particularly in the public sector units. So this is a sector I will watch out for. Do remember, I have been basically focusing on public sector units for many months now. As a matter of fact, there's a video here which will also tell you why I favor PSUs and what is the difference in the MWPL, TST, churns, etc., other aspects of this sector that sets it apart from other sectors. So, in the public sector units, I will basically focus on oil marketing companies. Naturally, oil prices are all over town. Public sector banks, defense stocks, power and energy stocks, and I will continue to seek theta decay in the interest rate sensitive segment. I've explained to you multiple times as to why. In the commodity space, the month end triggered a short covering in industrial metals. This is something that I wrote about in my Live Mint column. It's India's only media column to offer complete statistical data to its readers. And also in my video last week that, hey, month end would mean base metals would see short covering. They, coupled with a falling US dollar, base metal prices went up. So stock prices of metal mining companies went up last week. And if follow-up buying comes, you might expect higher volatility with an upward bias again in those stocks. But do keep watching the prices of metals on commodity markets before you go out and play these stocks. I remain of the opinion that oil and gas are moving exactly as per cyclical and statistical expectations. Hurricane Helene, which was a category 4 hurricane, and it came at 140 miles per hour speed, made a landfall on Friday in a place called Perry in Florida. Now, the hurricane was so severe that there are at least approximately 42 deaths reported in its wake. So that basically was expected to push gas prices higher, which has been the historical precedent, which is exactly why prices rose. And you will hear basically cries of breakout and God knows what other justification for telling you that it's a very strong surging bull market. Now these gas prices are going up only till the winter. I've explained to you in many Telegram posts, prior videos, etc. This is a cyclical rally, not a structural bull market. This pantomime is something that occurs every year. So do be careful about who you're listening to. I will continue with theta decay in the energy fossil fuel space as well. Bullion remains bullish in spite of the Fed usually pushing prices lower ahead of elections. Even if they do manage to push prices lower, if you ignore the temporary volatility, 2025 or even beyond 2025, bullion offers you a good bet for not only a store of value but capital appreciation as well. Friends, you wanted me to record a video about what if bullion falls ahead of the US elections. I'm in the process of recording a video. The thumbnail is here. It will be released next week. The entire game plan of whether you should surrender your long positions now, whether you should buy hacienda hedges, whether you should buy a fresh, what are my thoughts, what will I watch as a trader before taking my next step, I have shared my heart out in that video. Do make it a point to watch that video next week, please. That's all for me from now. Before I sign out from this video, a reminder to subscribe to my YouTube channel. If you haven't already done so, click on the bell icon to receive instant alerts about fresh videos being put about here. In the comment segment, I'm always eager to hear from you about how my videos are helping you become a better trader and what you would want me to record next. Whatever tutorial I can basically record to help you after your request, I will be very happy to record. So keep your requests coming. Also, please share my video with all your friends, family, social media groups, etc. and make my love's labor all the more worthwhile if I can basically help a bigger audience to trade better using informed, knowledgeable based trading systems. I thank you for your patience and being with me in this video till we meet again in my next. This is Vijay Bhambwani signing off for now. I wish you have a very profitable weekend. Take care. Bye-bye.